Great. Anybody have any questions? Joe?
The slideshow, the slide on the mid-caps caught my interest. Can you explain why it's been that performer consistently?
Well, when you think about mid-caps, you have a lot of small companies that grow into mid-caps and sometimes into large caps, so you're catching the ride up. You also have a lot of large cap companies that are affected when you think, especially with the mega caps, of how much exposure they have overseas. So much of their profits and revenue come from overseas countries that sometimes what happens across that big pond can affect the mega caps and large caps. Mid cap is kind of insulated from all of that. They're usually solid businesses. They've been in business for a while, which is why they're mid caps. And their businesses, when you look at some of the good dividend paying stocks, a lot of them are some of these mid cap stocks that really, you may not know them by name, but once you study them a little bit, you realize, boy, that's a good company. They've been around a long time, consistently doing a good business and selling whatever product or services they sell. Yes, sir?
Yeah, what do you see as a change with the Fed Reserve and the tapering coming on? Do you see an effect on the market?
We do. It's no surprise, Ben Bernanke in December decided to, as Ryan alluded to earlier in the presentation, they were buying $85 billion worth of bonds somehow, some way, putting that money, that liquidity into the system. And we benefited from that. When you look over the last couple of years, it's helped the stock market because that's $85 billion month in, month out that was going into the system somehow, some way. Well, Ben Bernanke decided to start tapering. We knew it was coming. It wasn't a surprise. We felt that it was built into the share prices, the stock market. The stock market really only gets canceled when there's a surprise, unexpected surprise, whether it be something like 9/11 or the Great Recession, which in hindsight, everything's always crystal clear, as the Great Recession hit us, as you really looked at the information revolving around the Great Recession, it should have never been a surprise. To some it wasn't, but to a lot of people it was. So when you had the tapering start, the markets didn't react that much. It was okay. When Ben Bernanke started from 85 billion down to 75 billion, and now at the last meeting last week, he announced that he's going to reduce it down to $65 billion. And we have a new Federal Reserve Chairwoman, Janet Yellen, who took over this past weekend. So she's 1 week on the job, and already she's got $20 billion less than she's been handed that strategy. We think by the end of the year, it'll probably continue to reduce more and more and more. But to answer your question, it's affected the markets, mostly the emerging markets. The emerging markets, and remember, we only 5% of our exports go to emerging markets. The emerging markets are taking it really hard right now, mostly because of the tapering. Their currencies are weak. Last week, Turkey increased interest rates in a big way. It lasted 24 hours and then the party was over. Emerging markets is really that big question mark in the global economy. What will happen if the Fed continues this tapering, which we expect it to do? But as far as the U.S. stock market and even developed international holdings like the Eurozone and so forth, we think that they're strong enough, the economies are strong enough where it'll weather that storm. But the emerging markets will continue to be volatile for a little bit longer.
Thank you.
Yes, Eleanor?
Maybe it's something going on, but Mario's prediction about the housing market, have you taken into account the baby boomers now who are about to sell all of their housing?
Marty.
I can speak for it.
Sure. So you do have that trend occurring, and they're definitely going to move a lot of different markets. But as I mentioned, actually the U.S. is in a very unique spot because a lot of countries in Europe and in Japan, you mentioned, have a real demographics issue, right? Their population is getting much older, and they're not replacing it through immigration. And I think as a country, we need to have an immigration policy that works, that is beneficial to all of us and to businesses. But the fact of the matter is, as you look at our demographics as a country, they're very strong. And again, the baby boomers are going to have an impact on a lot of different areas as they retire, as they downsize. But with that said, I don't think overall their impact on housing, it's certainly much more long-term than what's going to happen next year when some of them start selling. And again, I think the positive elements from our demographic situation will certainly limit some of that effect.
You know, for years, the housing market, you needed to qualify with a certain percentage of your income, and that kind of went to the wayside back in the late 90s. It used to be 28% of your income, no more than that, could go towards housing expenses if you were buying a home. Then President Clinton was the first president to really drive home the fact that he wanted more and more people to own homes. And then there was the big quote in 2003 by Barney Frank, who said, let's roll the dice a little bit longer. They knew that they were creating a problem, but they were happy to see people get money. You know that there was no income checks. You know that some of the mortgage deals were kind of, in hindsight, you wonder how these financial institutions can ever do that. It was just a matter of time before the house of cards came tumbling down. And now there's more regulations. The banks have money, and anybody who's trying to get a mortgage recently realizes it's a lot harder to get a mortgage. So somewhere in between, hopefully, we'll settle out. But more and more people, the housing recovery is on its way. I've been saying since the market collapsed a few years ago, anybody who was responsible enough looking to buy, whether it be their first home or a second home, with interest rates being near zero, historically low mortgage rates, there was no better time to get into the real estate market. Anybody who was responsible enough to want to do that, and that was part of their plan, shouldn't listen to the headlines and shouldn't get scared off. Now, we touched bottom with both interest rates, and I think we've seen the worst of the housing prices. That has all stabilized, thank God. Locally, in the capital region area, we weren't affected as much as other parts of the country. Other parts of the country has really been affected. We, because of some great dynamics going on, whether it be Global Foundries or the Albany Nano Science and Engineering, all the good things that are happening, it's been a good area. We've had some housing prices that have been soft. Maybe the houses stayed on the market a little bit longer, but they eventually sold. And is Claire still here? As I said to Claire, I was talking to Claire earlier, who's looking to be a new first-time home buyer, and I said, it's a great time. Mortgage rates are still low. The housing prices are still, they're rebounding, but they're not sky high, and it's still a great time to buy real estate. But the housing bubble did affect us, and the more people buy homes, it's not just the real estate agents that benefit. You think about every time you buy a home, what goes into that, and it's much more than the people building the homes. You think of the people that are making the furniture that you're buying for the homes, the appliances. You think about the people selling the insurances, the mortgages. You think of all that goes in, and this is why the housing recovery is so important for the overall economy to grow, and hopefully the housing recovery is getting better, and I think we've seen some good numbers over the last several months showing that, and that's great news for this country and our overall economy in this country.
And speaking of the housing, you think about the cost of higher education. I have 3 kids that just went to college, and I know the cost. If they're going to come out with some of these loans that maybe, let's say a couple could have maybe a couple $100,000 loan, how can they afford these homes, right? And how aren't they going to be the ones that are going to buy these new housing starts, right?
Well, they're going to try to buy them.
They're going to try, but we have to address that problem. I mean, higher education costs, I mean, it's 10% each year at least.
Well, you make a great point, and if you didn't hear the question, having children come out of college, whether it be their parents strapped helping them out, or children with student loans, and there's more and more of that happening. In this country, there's 3 things that I think we need to pay more attention to. Healthcare, which we know has changed dramatically over the last several months with President Obama's Healthcare Reform Act, which I think when we get another year or 2 into this, Matt Clark, Tim Sauls, we have a healthcare agency. We know the effect on businesses. Small businesses are just really, their costs are going up. so much more than anybody expected. Individuals, their cost of healthcare have gone up so much more. I had a conversation with somebody over the weekend who had a key employee, and you know, with the new healthcare premiums, the healthcare insurance premium almost doubled, and that's hard for people to accept. These people are just coming out of this great recession where they're getting back on their feet, and all of a sudden, what was supposed to be a beautiful thing for this country to have universal healthcare for all, it was a model that's based on, for the most part, young people, healthy people buying in. Well, we know that a lot of young people and healthy people aren't buying in. A lot of people that do need health insurance are able to get it, but I think we're going to see the cost of health care go up in a major way over the next few years. And what concerns me, we've already seen it, especially with big companies who have reduced the hours that their employees are able to work, which means that a lot of people have to go out and get a second job, sometimes a third job, just to be where they were at before. They're making these changes because of these healthcare rules. So healthcare is something that the country's trying to fix. I'm not so sure the current plan is the best plan. I think there's probably different ways of going about it. Hopefully they'll be able to amend that where it'll be good for all. Education, which is your question. It's so expensive for people to go to college. And these are our young assets, our young men and women that we want to be well educated. When you think of how many countries have such better educated students than our country, and you think of the money we spend on each pupil in this country, it's a train wreck, and it's not getting better. And unfortunately, so many of these young people are coming out of college with so many loans. What I think you may see happen is you may see more of these online colleges where these young people can get a college degree at a fraction of the cost. But somehow, some way, it would be nice if in this country we could make it more affordable. All of that TARP money that Ryan and Marty talked about earlier, if any of it was used to maybe to pay off some of these student loans, you know, these young people that came out that want to make a better living, you know, what better way to help those young people to, you know, kind of relieve them of those student loans so that they had more cash flow and they could spend money elsewhere in the economy instead of some of the ways that we spent that TARP money. We all know that TARP money was not used in the best ways. And last but not least, energy, but as both Marty and Ryan showed you, we are on the up with energy. So between healthcare, education, and energy, those are the three major problems in this country. One is repairing itself, the other two still needs work.
Yeah, hi. In thinking about the volatility that you're trying to minimize, could you explain the role of leveraged funds in your portfolios, why you have them, what you think the impact is on a stock market that's going up and down, and could you explain a little bit about the problems with compounding that those funds might induce?
It's a great question. We do use leveraged funds in our portfolio. We've used them for quite some time. The market bottomed on March 9, 2009, and I was actually, that's when I used to do the radio show on Sunday evenings, and on March 8th, I made it public that we started putting our cash to work because we were building cash up for months ever since Lehman Brothers went bankrupt in September of 2008. So we put that money to work, and not only did we put it to work, but we started, because I felt that the market came down in a major way. I wasn't sure just how much longer the market was going to fall, but I felt we were closer to the bottom than not. So as an investment advisor, it's our job, our clients give us discretion to make these investment decisions on their behalf, to prudently invest their portfolio in a manner that we feel we can hopefully reduce risk, get returns that are better than average, and have it be prudently invested for the tolerance of risk that clients are willing to take, whether that be a growth investor or a conservative investor or somebody in between. So not only did we put our cash to work, but we actually invested in overweight financials technology, and we used leverage at that time. And our average returns in 2009 were phenomenal because of that. Now, since then, we still use leverage, mostly in technology and financials. For those of you that wonder what I'm talking about, you know the symbols probably because you love them last year. TQQQ is the leveraged NASDAQ holding that we use, and also on the financial side, we use FAS, the Direction Financial Book. So it's a way for us to get a little more out of an area, a sector that we want to be invested in, that we're bullish on or optimistic about. So with a leverage fund, let's use the TQQQ. If the NASDAQ goes up 10%, the leverage fund could possibly go up more than that, whether it be 2 times, 3 times the leverage, and it's not always the formula. And what happens is, every night it gets squared up, whether the trend be going up or the trend be going down. Now, we've had leverage for about 5 years because the trend has been going up. But a month like January, where we have this little setback, you see these leverage funds lose more than some of our other holdings. But we think this setback is short-term in nature, so we haven't been scared out of that. We did take some risk off the table at the end of last year. For our clients especially our clients that take distributions out of their portfolio, we had our returns were very good, and we thought it was time to take some profits off the table, which we did, take some risk off the table and re-diversify those assets. So we did reduce some of our holdings in these leverage funds, but they are leveraged. We don't feel that most investors should use them on their own. We use them, we understand them, we watch them carefully. You could see us sell out of them at any point. You could see us buy more into them, but overall, it gives us a little more in those areas that we like. Not right now being technology and financials, which we still like. As a very good friend of mine told me once, and I've used this line on the radio, the markets can't go anywhere unless the financials follow. Go back to the 2009 when everybody thought the banks were going out of business. There was no way the banks could all go out of business, and they had truly their worst day. And since then, financials have been one of the better performing sectors of the market. So leverage is something we use minimally, but we use it in a prudent manner, mostly on our qualified accounts, IRAs. We don't use them in our tax-managed portfolios. Good question, though.
Steve, moving forward at this point, where do you see yourself in terms of positioning some of these portfolios with representation in the healthcare industry? Are you going to just kind of sit and wait, or are you going to unload some, or are you going to add some, or what's your position right now?
Well, I think everybody knows in the room that very seldom do we buy individual stocks. We will buy individual stocks at the right time for the right reasons. Back in 2011, when the world looked at the headlines, it all started with Greece, and then the Eurozone being really in a bad frame, the USA losing its AAA credit rating, and so many other things. The stock markets were pretty volatile, if you remember back in the summer of 2009. We actually invested in some individual stocks back then because we knew we're not market timers. You'll never see us get all in or all out of the market. But we will add risk or take risk out of our portfolio. So we can do that a number of ways. Back then, we wanted to stay invested in the markets, but we wanted to take some risk off the table. So we sold out of some of our exchange-traded funds where we get broad exposure to different areas in the market. We bought companies like Procter & Gamble, Johnson & Johnson, and GE. And in hindsight, they were great investments for the reasons we bought them. We bought them because we wanted that dividend. We got 3 to 4% dividend at that time. And we had 3 great mega cap companies that were undervalued. Now, 2 of them are overvalued. The 2 healthcare companies, Johnson & Johnson and Procter & Gamble, are very overvalued compared to the market. So one of 2 things has to happen. Either the market as a whole has to have its PE ratio, which right now, let's say it's a 16. Johnson & Johnson was selling at a 24 PE ratio. So the market either has to increase its PE ratio, or Johnson & Johnson and some other healthcare companies have to come down a little bit. A lot of people were buying these companies because of the dividends for the same reason I did as well. And the problem is that some of them may be overvalued. So right now, we don't have any direct exposure in healthcare other than our core holdings is the S&P 500 index, and the allocation in the S&P 500 index of healthcare companies is about 14%. And you'll see some of our other holdings have exposure, but we don't have any direct exposure to healthcare because we're still not sure what this Healthcare Reform Act is going to do for some of these companies. And we just as soon stay broadly invested. I think our clients have been very happy with the returns we've taken using exchange-traded funds. They may not go to their neighbor's house on Saturday night and brag about owning this stock or that stock, but they have a well-thought-out, well-rounded portfolio using those asset classes. And that's how, right now, we're just kind of market neutral on that.
I see, moving forward, looking back at financials and Bank of America, whatever, you and I have talked about that. So, where do you see financials going at this point?
As my good friend said, the market can't go anywhere unless financials go with it. And financials, as interest rates go up, financials have been strapped. Some people in this room are in the banking industry, and the profit margins have been low because interest rates have been low, and there's just not as much profit margin there for them. So we still like financials. We think that financials will continue to do well, but we also think that the stock market will do well. We're not here to sell stocks over any other asset class. We truly, when we look at all the asset classes we have available to our clients and how to invest, we just think that stock as an asset class is still a asset class that should do well, and we're not afraid of it. This January, not the weather, but the stock market volatility hasn't dampened the spirits. It hasn't dampened the optimism. It'll be interesting to see what the jobs report is tomorrow. Hopefully it'll show some signs that the December wasn't as bad as it was. January, I don't expect good numbers because of the weather. Just the weather alone kept so many people home. They weren't out shopping, and so many people were laid off. But financials, I still believe in them, and we're still overweight. Ryan, Marty, and I meet week in, week out. Every holding that we have is the same in all of our strategies, whether 100% of my personal money is invested just as your money is. I have the exact same holdings that each and every one of my clients has. The only difference is I'm in our growth strategy, our more aggressive strategy, which is right now it's about an 80-20, makes 80% equities, 20% cash, alternative assets, and fixed income. And some of our clients are more balanced or more conservative or capital preservation even. But Ryan, Marty, and I, each week we meet as an investment committee. We pull up each and every holding that we own on behalf of our clients, and we talk about each and every holding. And we're watching it closely. We still agree that financials and technology, we're very comfortable being overweight in those areas than any other area.
It seems every 6 months that the government has to raise the debt ceiling. As a result, the debt to gross national product is growing. Do you see an impact on that in the near future or down the road?
Can't we all just get along in Washington? The debt ceiling in a nutshell, people ask, what is the debt ceiling? Well, the debt ceiling is basically we spend so much money and we have to raise the debt ceiling because we're spending way more money than we need to. And I don't really want to talk politics, but if you have a house full of stuff and all of a sudden it's just chock full of stuff, I can't use the S word that some of you may think you should be using right now, but if you have a lot of stuff in your house and it's just not feeling good, you don't fix it by putting an extension on the foundation of your house and raising the roof. You get rid of some of the stuff. Unfortunately, there's a division between both sides of the aisle. We need to cut some of our spending. Ryan, Marty, and I, a couple years ago, were out in Chicago, and we were actually in a meeting with Ernst Bowles and Alan Simpson. And they used the 28-year-old as an example, and Ryan happened to be 28 at that time. And President Obama had this bipartisan committee that looked at how can they fix some of the spending and our future financial problems. And it was brilliant. It's still brilliant. It's not perfect, but it's better than what we've lived through over the last few years. And one of the ways they need to fix it is with some of these entitlement programs, whether it be Social Security, and I'm not saying you change it for the people that are collecting it now or within 10, 15 years of collecting it, but they use the 28-year-old as an example. They couldn't get past the fact that raising the maximum Social Security age from 67 to 68 years old, how that would affect somebody that was 28 years. AARP and some other big firms lobbied the government to say people didn't have enough time. 40 years wasn't enough time for these 28-year-olds to think about having to wait one more year to take the full Social Security benefit. Well, to probably all of us or most of us, that sounds like a simple solution. 40 years, I would think, is plenty of time. Heck, we have a lot of clients come in that are 4 years away from retiring, and they haven't even thought about it. And all of a sudden, they want to fix it. It's like when you get on an airplane and you call your attorney to get a will drawn up because the plane might crash. The unemployment is high. And Marty talked a little bit about immigration. I was down in South Florida last week, and I looked at some of the hardest workers I've ever seen, and we've seen them locally as well, and most of them are immigrants. We have 35 states where you can be on welfare and get paid more than minimum wage paying jobs. There's not that incentive for people to go out and work. So that debt ceiling is affected by us not fixing some of the spending that we do in the country, which means the government, and it's not unusual that the government raises debt ceilings at all. And thank God we've had a good economy because the deficit has come down over the last year compared to where it was and where it was projected to be. So to sum it up, we're going to have this debt ceiling fight again and again and again. And hopefully both sides of the aisle can come up with a compromise and negotiate somehow, because that's really their job when they get elected to office. It's their job to negotiate with the other side and do what's right for the people as a whole. Hopefully, both sides of the aisle will have some give and take, and they'll fix some of the spending, and also, where they can raise the debt ceiling in a proper way. What worries me is 20, 30 years from now, when you look at the figures, financially speaking, if we continue to spend money the way we're spending now, there's almost no way the country can sustain that kind of spending. And that's what we should all be concerned about. But as we know in Washington, they only care about the next 4 years. But we need to really start thinking long term. So the debt ceiling, Tom, we're gonna continue to live through, and let's just hope Washington, they can get along a little better than they have, because where would we be if they got along over the last 5 years? We've done well with them fighting like they have, but where could we be if really we had different policies that was better for the U.S.?